pound is falling against not only the stronger US dollar, but also against other major peers such as the euro, the yen, and the Canadian dollar, whilst UK gilt yields have climbed to their highest level since 2008. And this is as investors are pricing in a combination of political instability and structurally higher inflation risks. So pressure on sterling and gilts have intensified as traders are increasingly expecting or betting that Andy Burnham could emerge as a serious challenger to Prime Minister Keir Starmer for the leadership of the Labour Party. Now, recent political developments have opened a potential path for Andy Burnham to enter Westminster sooner than the market had anticipated, raising the possibility of a leadership challenge from him becoming a near-term risk rather than a long-dated scenario. Now, prediction markets are increasingly reflecting that shift. According to Polymarket pricing, Burnham is now viewed as the leading contender to become the next UK Prime Minister in 2026 at a 42%, and that's ahead of figures such as Angela Rayner and Wes Streeting. So for the markets, though, Burnham is increasingly viewed as the least gilt-friendly potential successor. So investors fear a Burnham-led government could loosen UK's self-imposed fiscal constraints at a time when UK debt sustainability and sort of the broader fiscal backdrop are sort of not in or in a precarious position. So that's really contributing to what could be called the Burnham premium in UK assets. And this is the political risk premium reflected through higher gilt yields and a weaker pound. But also, whilst the domestic backdrop is creating problems, it's also sort of colliding with a deteriorating global inflation environment. So global bond yields are also moving higher amid renewed tensions surrounding the Middle East, which has pushed oil prices sharply higher. Brent crude is trading above $107 the barrel, basically after President Trump signaled towards growing impatience with Iran and suggested that the US could cope without the Strait of Hormuz reopening. Now, this rise in energy prices is also reinforcing fears that global inflationary pressures will remain persistent across developed economies. US Treasury yields have also risen to 4.52%. As far as UK traders are concerned, though, and the Bank of England, the markets are pricing in 68 basis points of rate hikes from the central bank across 2026 as markets sort of reassess that inflationary outlook. However, it's interesting because unlike a typical hawkish repricing cycle, which you would expect to support sterling, the pound is actually weakening, and that is sort of as rate cut on those hike expectations. Now, this divergence does suggest that the markets are actually becoming more concerned about fiscal credibility and political instability rather than supportive yield differentials. Sterling is on track for its worst weekly performance against the US dollar since November 2024. Looking ahead, attention is going to remain on political developments as well as oil prices as we head towards the weekend. For more videos like this, please do like and subscribe.